Hey everybody, Joel Johnson here, Managing Director of Johnson Brunetti with another segment on retirement and investment success. For those of you joining us for the first time, Johnson Brunetti is a retirement and investment specialist. We work primarily with either retirees or people getting ready to retire. So that is our whole focus. Retirees or people getting ready to retire. It takes a different investment philosophy, and we're really blessed with the people that we serve here in the Northeast at Johnson Brunetti. So what we're talking about today is asset allocation and building a balanced portfolio. Asset allocation and a balanced portfolio. What does that mean? And again, we're going to keep this pretty simple today. But the first question I like to ask is, well, why? Why do we need to have asset allocation? Some of you know that over time, the stock market has been one of the best performing places to be. And real estate is about the same. So stocks and real estate, blue chip stocks and institutional real estate, if we go back over 20, 30, 40 years, best assets to be. However, what happens when we measure that in a short period of time? Well, we have this volatility. We have the ups and downs. So one of the reasons to asset allocate or to build a balanced portfolio is to avoid that volatility. Now, the intellectual person, the real smart person, and some of you listening to me, I know you're trained engineers and actuaries and you're pretty bright people, very well educated. You say, well, wait a minute, Joel. If stocks just do best over the time and I feel like I can ride it out, why don't I just have 100% of my money in stocks, good blue chip stocks? Or why don't I have 100% of my money in real estate? Well, let's remove real estate from the discussion and just talk about stocks for a minute today. The reason why you don't have 100% of your money in stocks is because most of you, and I'm going to say all of you listening to my voice right now, can't do that. You won't stick with it. We are human beings. We are driven by fear and greed. When the market's going up, we wish we had more money to put into it, or we consider borrowing money sometimes to put money into the market. When the market's going down, we want to get out because we think it's all over. You can't handle it. Please be honest with yourself here, okay? If brilliant money managers, traders, people worth billions of dollars can't handle it, maybe you should do what they do and invest like they do. Now, you can turn me off right now if you think you're smarter than all that. That's fine. I'm not talking to you that thinks you're smarter than all that. I'm talking to you that thinks that you can be honest enough with yourself to know that I can't handle the ups and downs. I hated the way I felt in 2008. I hated the way I felt in 01 and 02. And the answer to that is getting a proper balanced portfolio so you can stick it out. Let's talk about why we want to do that a little bit more. So if you think about what the market does, yes, over time, the market goes up. But it's these periods of time that we have a very hard time. Let's say that's 2001 and 2002, where we might have been down in the market 40%. Okay? Think about this. Think about you retiring, have $1 million saved up, and within a 10 to 18-month period, your $1 million is worth $600,000. How are you feeling at this time? Are you just sitting back like a real smart person and saying, hey, that's okay, the market always comes back? Or are you getting very nervous? Are you worried about going back to work? Are you worried that are you thinking I should have just left my money in the bank because I wouldn't have lost anything? A zero rate of return would have been better than what's going on now. Let's be honest with ourselves here, folks. Okay? So we like over time the market going up. We don't like that negative 40%. Now, some people, they got hit with the 40% downturn in 01 and 02, and by 07 they were finally back to break even 7 years later, just in time for 2008. What happens in 2008? Another big hit of how much? On the S&P 500 index, our blue chip stock index as we measure it here in the U.S., 37, 38%. Doesn't feel very good. There we are again. And at that point, some people just throw in the towel and say, I had enough. I don't care if I only have half as much money as I started retirement with. At least I don't want to lose anymore. That's why people want to build a balanced portfolio. It's our emotions, so we can't handle it. And some people, quite frankly, even though they're very, very wealthy, say it's just not worth it. I know a very wealthy gentleman out in the San Francisco area. His net worth is probably between $30 and $40 million. He doesn't buy any stocks, any individual stocks. He has some private investments. He's got some real estate. He hates the volatility of the market, and he doesn't like it that he can look at it every day. And so I'm not an anti-stock market guy at all. Let's talk about building this balanced portfolio and why we do it. So a way to smooth out this roller coaster ride is by building a balanced portfolio. And again, we're going to keep it real simple here today. At Johnson Brunetti, we use all kinds of different strategies and different types of investment products. But traditionally, when people think balanced portfolio, they think stocks and bonds. They think stocks and bonds. So let's just talk about, let's pretend that we've got a portfolio that's 40% in bonds and 60% in stocks. And how does that contrast to what would happen here if we had 100% of our money in the cheapest index fund you can find out there, like Vanguard Index? Well, here's how, Vanguard Index 500 is the name of the fund. Here's how it contrasts. The first 2 weeks of 2016, let's just think about the first 2 weeks of 2016. The market was down, depending on which stocks you're looking at, whether it's small company stocks, large company stocks, anywhere between 8 and 12%. Just the indexes, just the averages were down 8 to 12%. I'm not talking about individual stocks, many of them down 20% or so, but just the indexes. Well, while the stock indexes were down about 8 to 12%, and we'll just write that down there, 8% to 12%, okay? The bonds, especially if you had a portfolio of bonds that was well diversified with some government bonds, corporate bonds, and so on, did what? They were up. Bonds were up. Bonds were up somewhere between 2 to 4%. Okay? So I got a text from my uncle, Uncle Gary. It's his real name. Probably shouldn't have given you his real name, but what the heck, I did. Gary, I'm sorry. I won't give away your last name. And he doesn't live in the Northeast, so don't worry about that. But anyway, I get a text from my Uncle Gary. My Uncle Gary says, Joel, I have a balanced portfolio. What should I do? I'm really nervous about the market. I said, Uncle Gary, let's just keep this real basic. Let's pretend you use mutual funds that you used to use years ago. I don't manage Uncle Gary's money, okay? He manages his own money. Let's pretend you use mutual funds like he used to, and you've just got a good, well-diversified portfolio. Here's what's happened to your portfolio. The market overall, and I told him, let's pretend for a minute the market's down 10%. But only 60% of your portfolio went down 10%. So 60% of Gary's portfolio went down 10%, which is how much? 6%. He was down 6%. All the mayhem, all the craziness on the news, all the people getting on the news saying the world is over, okay? The stock portion of his portfolio is down 10%, but he's only got 60% stocks, so 60% of 10 is what? He's down 6% of his overall portfolio. But no, he's not. Wait a minute. He had 40% of his money in bonds, and 40% of 3% is what? 1.2%. So watch this. Uncle Gary is getting nervous because he's watching too much news. But in the reality, his stocks are down 6, his bonds are up 1.2, therefore he's down 4.8%. The world sounds like it's coming to an end. If you watch the news, it's the worst 2 weeks the market's ever had in history of the year, and he's down only 4.8%. Big deal. Why is it not a big deal? Number one, it's not a big deal because he's going to be okay. He can afford to be down on a short-term basis, even on a 1 or 2 year basis, down 4.8%. Heck, he can afford to be down 10%. It's not because he's wealthy. He's a real hard-working person that just saved enough to have a decent retirement. It's because the world's not going to end if he's down 4.8%. Okay? Not only that, but with this balanced portfolio, he's probably averaged somewhere around 7 to 8% over the last 7 years. So asset allocation is so important. It gets you to hang in there when the going gets tough. Now, if he had 100% of his money in stocks, he'd be having a whole different conversation. Now it's, Joel, is it going to go lower? Should I get out now? And I say to him, Gary, we're not market timers. I don't know if you should get out now. Okay? So it's a whole different conversation if you don't create a balanced portfolio. This is why asset allocation and creating a balanced portfolio is so very, very important. Now, it doesn't just have to be stocks and bonds, folks. I wrote up here stocks and I wrote bonds, but you could use real estate to balance a portfolio. You could use annuities to balance a portfolio. And the neat thing about certain types of annuities aren't right for everybody, but the neat thing about certain types of annuities is they've got a guarantee of principal. You can't ever lose your principal, where bonds can even go down in the example I put up here. The idea is, regardless of what you use, whether bonds, stocks, mutual funds, real estate, annuities are right or wrong for you, that depends on your individual situation. So I'm not recommending any specific thing here. But what I'm saying is, I am recommending you create a balanced portfolio. Thanks so much for joining us on this segment today. I hope it's been helpful. Stay tuned for the next one. And as always, if you want help or if you have specific questions, please feel free to call my office, 1-800-208-SAFE. That's 1-800-208-7233, or send us an email. Thanks for joining us.